In this video, we're going to look at how to process balance day adjustments. For this video, you're going to need to have a pen and paper to work through these. Okay, we have 5 balance day adjustments here. The first one, wages of $250 are owing by the business on balance day. Before we go any further, balance day adjustments are always processed on the 30th of June that financial year, or the last day of the financial year. So wages of $250 are owing by the business on balance day. That's a type of expense. It is not a prepaid expense. It's an accrued expense. The business owes expenses on balance day. The journal entry, therefore, is this. We debit the expense, we credit accrued expenses. So the journal entry will be this. It will have wages, DR, for $250. And then accrued expense, CR, for $250. The next one. Insurance expense has been prepaid 1 month in advance. Prepaid is obviously going to be prepaid expenses. Here's the journal entry. We're going to debit prepaid expense, DR, for $400. The credit will be the expense account, which is insurance. Insurance, CR, for $400. The next one, the business is owed commission revenue of $500. The business is owed revenue. It's not an unearned revenue, it is an accrued revenue. Revenue owing, there's the journal entry there. We're going to debit accrued revenue, accrued revenue, DR, for $500. Our credit is the revenue account, which is commission. Commission, CR, for $500. The next one, the business received rent 1 month in advance, $500. So we haven't earned this $500, so that's an unearned revenue. There's the journal entry there. Debit the revenue account, credit unearned revenue. Revenue account is rent, Rev, 500. Credit is unearned, Rev, for 500. This final one, store fittings will need to be depreciated using the straight line method for a full year. The original cost is $15,000 and its residual value is $3,000. Expected life is 4 years. Okay, we need to claim depreciation for the year. To figure that out, we're using the straight line method, which is original cost minus residual value all over the useful life. That equals, the original cost is $15,000 minus residual value is $3,000, all divided by its useful life, which is 4 years. That's going to equal 12,000 divided by 4, which equals 3,000. Our depreciation is 3,000 per year. Our journal entry will therefore be depreciation expense for 3,000. That's our DR. Our credit is accumulated depreciation. That's a CR for 3,000. That's on the store fittings. What we now need to do is process these transactions in our MYOB. So this first one here, this journal entry, this journal entry, this journal entry, and this journal entry here. Before we process any of these journals in MYOB, I'm just going to put here a little tip for the exam. So what you should do to help you with this is just right here, debit the pair. This is going to help us decide if these accounts are either assets or liabilities. So DR, debit, they're assets. CR, therefore, are our liabilities. DR, the assets, are PEAR, which stands for prepaid expense. AR is accrued revenue. Prepaid expense and accrued revenue. What's left over? We have our accrued expense and our unearned revenue. Therefore, in this example here, accrued expense, this will be a liability. Prepaid expense is an asset. Accrued revenue is an asset. Unearned revenue is a liability. Okay, let's now go into MYOB and record these transactions. So what we need to do, we need to go up to Accounts, Record Journal Entry. Up here, tax inclusive, there's no GST, we're going to untick that. It's a year-end adjustment. The date is 30 June 2017, last day of the financial year. Our first journal entry is wages and accrued expense. So we're going to find our wages account. It's an expense account. There it is, salary and wages for $250. That's a DR. Our credit is accrued expense. Now we know from our journal that we wrote down that accrued expense is a liability account. So we're looking in liabilities for accrued expense. So if we keep looking down, you can see it's not there. So we're going to have to create an accrued expense account. So let's do this in between these two. So we're going to do, this is 2-1520 and this is 2-1530. So we're going to do 2-1525, 2-1525. So we're going to go in new, 2-1525. It's not an other liability. Yes it is, other liability, account name, accrued expense. It's a detail account, leave the rest, okay that. Tax code is going to be NT. No tax on this, or no GST, and we're going to okay that. Now we can go ahead and find that account that we just created. It was a liability account. It was called accrued expense. There it is there for $250. Let's tab across. Next journal entry was prepaid expense and insurance. Okay, let's find prepaid expense. Firstly, it's going to be an asset, and I can see here that there is no prepaid expense. There's this accrued revenue, that'll be important for later. So we want to create a prepaid expense around this account. So I'm going to do 1-1345, 1-1345. New 1-1345. We'll call this prepaid expense. I'm going to OK that. GST code is N-T. OK that. Let's now select that account we just created, prepaid expense, tab across. It was 400. Keep tab across. Now this was insurance expense. So it's an expense account looking for insurance. Expenses. There's public liability insurance there, business insurance. Let's just choose business insurance for. Now I'm going to say there's no GST for the purposes of this. So I'm going to go N-T. It'll be really clear in the exam. These balance day adjustments won't have GST on them. Okay. Next transaction was this accrued revenue and commission revenue. Accrued revenue, commission revenue. We saw earlier that accrued revenue was already created. It was here. The amount was 500. Tab across. The other side of that was commission revenue. So we're looking for revenue accounts, expense, cost of sales, income. Commission revenue is not there. It's going to be in other income, interest and other income. You could add a new account and call it commission revenue. Let's just put it into other income. No GST on this, and -T. For balance day adjustments, there's not going to be any GST for you to worry about. Next one is rent revenue and unearned revenue for 500. Rent revenue and unearned revenue, so we're going to go in here. Rent revenue again will be in other income. There is no rent revenue in here. Let's go to our income in here. Cost of sales income, there's nothing in there. I'm not going to put this to other income because we've already put something commission revenue to that. So really we do need to create another account now. So I'm going to call this 8-3000. For commission revenue, you could have created that as well. So I'm going to go new. It's going to be other income, 8-3000, rent revenue. Okay, that. Tax code is NT. Okay, that. Our rent revenue is for 500. Let's choose that account. It's 8-3000. It was for 500. Tab across. The credit is unearned revenue. So let's see if that's in there. That'll be a liability. Unearned revenue. You can see it's not in there. So we're going to put unearned revenue around this accrued expense. So we're going to go 2-1526. 2-1526. 1526. And that was unearned revenue. Okay, that. This is N-T. Okay, that. Now I need to find that account we just created. There it is there. Unearned revenue for $500. That looks fine. Let's keep going now. We have depreciation. So depreciation expense for 3,000. That's our DR. So we need to find our expenses. We're looking for our depreciation now. It was on, see up here, store fittings. So what we need to do is find store fittings depreciation specifically. So if I go back to my expenses, go down to all these depreciation expenses, where's store fittings depreciation for 3,000. Other side of that is accumulated depreciation, which is a negative asset. So we need to find, see here, accumulated depreciation. Office equipment is not it, it's store fittings. And that'll be 3,000, the credit. That's a big journal entry. Once you've finished all that, we're going to push record.